Yeah. I'm going to take the liberty to start introducing Morgan Ricks. Morgan Ricks is the Herman O. Lowenstein Chair in Law and Professor of Management. Sorry, tongue twister. Owen Graduate School of Management and Vanderbilt University Law School. Morgan Ricks studies financial regulation. He is the author of The Money Problem, Rethinking Financial Regulation, University of Chicago 216, and a co-author of Networks, Platforms, and Utilities. And not the, I don't know if the camera's on me, but here it is. And that's no small book there. And it looks like a law professor's delight or something. Okay, that was, but I started actually looking into this, and it's a beautiful, going through briefs and law cases, and I found it fascinating. Professor Ricks joined the Vanderbilt Law School faculty in 2012 and was a 2019 to 21 Enterprise Scholar. Before he entered the Legal Academy, he was a senior policy advisor and financial restructuring expert at the U.S. Treasury Department from 2009 to 2010, where he focused primarily on financial stability initiatives and capital markets policy. Before joining the Treasury Department, he was a risk arbiter trader at Citadel Investment Group, a Chicago-based hedge fund. He previously served as vice president in the investment banking division of Merrill Lynch and Company, where he specialized in strategic and capital raising transactions for financial services companies. He began his career as a mergers and acquisitions attorney at Wachtell, Lipton, Rosen, and Kantz. You can see he's had a really a long history there, and it's changed, and there's a lot of evolution, I'm guessing, too. And about the talk, in his talk, Professor Morgan Ricks will return to the most basic questions of money and banking. What exactly is money? Who should be allowed to issue it? And how should a modern financial system be structured to best serve the public? Drawing on his influential book, The Money Problem, and his policy work at the U.S. Treasury, Ricks will explore why the design of the monetary system is not a technical afterthought, but a core issue of democratic governance. He will explain how our current arrangement, dominated by private bank money creation, produces instability and inequity, and why thinking from first principles can open the door to better alternatives. Ricks brings a rare blend of theory and practice, combining insights from law, economics, and financial regulations. His talk will challenge common assumptions about money and point towards reforms that could deliver greater
Yeah, well,
stability,
that's why I'm trying to figure out
resilience,
where it is. So I
and
don't know where it is.
fairness in the monetary system. With that, we are blessed to have you, Professor Ricks. We're a learning organization, and we want to learn, and we want to be a good citizens group advocating and working with our legislators too. Thank you very much for being here.
Okay, well, thank you so much. Really a delight to be here to speak to this group. Am I able to share my screen? I have a few slides.
Yeah,
Let me try.
Yes, you should be able to.
Looks like I can. Okay, great. And should I do a slideshow version here? Let me see.
Sure, yeah.
All right, is this visible? Are the slides visible to everyone now?
It is.
Yes.
And so people know the three dots on the top of your screen next to Morgan Rick's screen name, you can control the size on viewers' ends as well to make it larger if you need to.
Okay.
Go ahead, Dr. Ricks.
Well, again, thanks so much. It's really a pleasure to be here. I want to start by saying what I plan to do. You know, the topic, the title is Monetary System Designs and First Principles, and you know, I recognize I'm speaking to an audience that's quite well informed, and in many cases experts. And so my reason for starting from first principles is not that I think it's not a didactic purpose. It's to sort of surface areas of agreement and disagreement. And I'll start with a little digression here. My oldest daughter is in middle school and is taking physics. And I was speaking with her a couple of weeks ago about the speed of light and tried to introduce some special relativity concepts and Einstein's famous thought experiment of a train going by, and there's two bolts of lightning that hit on either end of the train, and the observer on the platform thinks they happen at the same time. The observer on the train thinks that one follows the other. And the point, of course, is that time is relative based on your frame of reference. And I was trying to explain this to her, and I did not succeed. She was pretty sure that the person on the platform was right and the person on the train was wrong. And incidentally, her father and Albert Einstein also seemed to be wrong. But this got me to myself went on a little detour when I should probably have been doing other things of trying to learn a little more physics. Both looking into general relativity quickly was out of my depth, and then quantum mechanics. The reason I'm telling this story is I ended up watching some old Richard Feynman lectures that are on YouTube. YouTube is largely a cesspool as far as I can tell nowadays, but it does have some nice, some wonderful things that you can sit down and watch a bunch of old Richard Feynman lectures from the 1960s, and he has this wonderful way of always beginning with the basics, in the almost reductive, in the sense of stripping away anything unnecessary and trying to level set on what it is we know, or at least think we know, before he then poses the puzzles and the contradictions and experimental evidence that leads to the questioning of those original assumptions or the need to reconcile aspects of the world with those theories. And I really admire how he does that. I would never even hope to emulate Richard Feynman's intellect, but I can try to emulate his approach. And I think for similar reasons, because often he was speaking to expert audiences, but he was trying to reveal sort of the areas of agreement and disagreement in part. And so that's the motivation for me beginning with first principles. I do think it's helpful. I hope it'll prove helpful in clarifying some contemporary debates to begin this way. So questions about the administrative independence of the monetary authority. That's a big topic in recent weeks. One thing I want to convey in this talk, perhaps above anything else, is that banking law is monetary system design. Banking law is monetary system design. I think there's a tendency to think of the central bank as being public and monetary, and while thinking of banks, investor-owned banks, as being essentially private and financial in some important sense. And I want to challenge that assumption and to think of the system as a system, as an integrated system, and how it works as a system. So I'll be conveying a view, and this will echo some of what Bob Hockett said in his talk and has said in his own scholarship, of thinking of banks really as franchisees of the state for the issuance of the money supply and for the allocation of the monetary portfolio. And I'll come back to that. But I think this approach will open up our field of vision a bit. Just so I'm not misunderstood, I think, thinking from first principles doesn't mean necessarily arriving at a radically different place from the status quo. In fact, in some ways, while I'm very critical of the status quo, I do think that there was a logic to what I'll call the New Deal system of money and banking, the system we had arrived at between the National Bank Act of 1863 and 4, through the Federal Reserve Act, and finally getting to the Banking Acts of 1933 and 35. I think by that point, we had a system that had a logic to it. It was an implicit logic. It was never really fully spelled out, that I think could be sort of elucidated by a first principles approach. And in fact, my own sort of policy prescription, I have a number of policy prescriptions, but one way of thinking about them is that I'd like to follow through on the New Deal system of money and banking. I think in many ways was designed quite well. It certainly was not perfect by any stretch, but we can better see its merits and demerits by starting from more of a first principles approach. So I'm not advocating, throwing everything away and doing something that's completely different and unheard of. On the contrary, I think there's a lot of to be valued in the system that we had for much of the 20th century. Our current approach, we've dismantled. We've allowed banking law to collapse in many ways. I'll talk a little more about this shortly. And I think a lot of our contemporary problems in finance and in the economy can be traced back to this. Certainly not all of them, but many of them. Skyrocketing asset prices, escalating economic inequality, geographic maldistribution of production, secular stagnation. I think in many respects, these pathologies can be traced back to insufficient attention to the design of our monetary framework. And so I hope to say a little more about that shortly. Lastly, before I really kick it off, I'll be taking a system design perspective. And in fact, or an infrastructural perspective is another way of putting that. Patrick mentioned an article I wrote titled Money's Infrastructure. I have another article that I wrote with Professor Lev Menand at Columbia Law School titled Rebuilding Banking Law, Banks as Public Utilities, and I'll also be drawing on some of those ideas here. But the idea here is to take a more public utility or infrastructural view of the monetary system. And in fact, I've taken to not talking about money, quote unquote, itself so much, but talking more about the system level. And so my talk will be drawing on prior scholarship, including my 2016 book, The Money Problem, and as Stephen so kindly pointed to, the book Networks, Platforms, and Utilities. This is the first edition. The second edition will be out next year from Princeton University Press. And there is a chapter in here on the monetary system and another chapter on payment systems, and then a third chapter on financial market infrastructure that might be of interest to this group. And some of what I'll be saying is echoed in this. That book is co-authored with my colleague Ganesh Sitaraman at Vanderbilt, Shelley Welton, who's at University of Pennsylvania, and then Lev Menand at Columbia. Okay, so I said I'd start with an infrastructural perspective, and let me just be as reductive as possible. So, we can think of a monetary system in basic terms as a spreadsheet. And I want to start by thinking in terms of a spreadsheet. So it's a spreadsheet with two columns. The left-hand column is some kind of identifier for each person. I use person broadly, each agent, if you want to prefer to speak that way, in the economy. And the right-hand column indicates a number, a balance associated with that person's identifier. So that's their bank balance, so to speak, their money balance. And the system works by conveying to the operator of the system when Bob wants to make a payment. Bob doesn't have a lot of money in this one. Let's say Alice wants to make a payment to Bob. Alice sends some kind of authenticated message to whoever's managing this, and we'll talk about that momentarily, to the manager of the spreadsheet, and that person deducts an amount from Alice's account and credits the same amount to Bob's account, right? We all understand how this works. I'm trying to dephysicalize money in this picture, and I'm being quite deliberate about that. I don't want these balances to represent a claim to anything in particular. They have value because for some combination of reasons, maybe in part because we've all agreed that they have value. So there's sort of coordination game going on here. It's also the case, you see, I have the US government as having a balance in this spreadsheet and its own willingness. In fact, it's not just willingness, but it's requirement that taxes be paid in terms of these balances in this spreadsheet, or that legal judgments be rendered in terms of balances in the spreadsheet, right? That in itself can anchor this this infrastructure, this form of money, as being the established form of money in the economy. And obviously, there are network externalities here that would presumably cause most people to converge on using the same money, right? It's theoretically obviously possible for there to be multiple monies operating in the same place at the same time, and that does happen on occasion. But it's useful if everyone's sort of accepting the same one. And so I'm just showing this as a spreadsheet. This is a fiat money system, right? There's no and I don't want to think about these balances as claims to any particular set of assets. They have value just for the reasons that fiat money has value, and I think we can probably specify multiple reasons as I mentioned. So I want to imagine that these balances are non-interest bearing for now. We can come back to that later, but I just want this sort of picture of a monetary system to be in our minds. I think this is a useful place to start as our baseline, not thinking about tokens that are physical tokens that are passed around in the world, but as just a record, a centralized record in this case. And I think this is useful. You know, there's within the law, there's a history of doctrines, for instance, of negotiability. Negotiability is a doctrine that allows intangible pieces of paper to be essentially passed around more easily, to be more liquid. It's a set of legal doctrines that emerged in sort of the late Middle Ages in England and in Italy, and spread from there. And the leading commercial law scholar in the 20th century, who expert in negotiability, he wrote a book called The End of Negotiability, a guy named James Stephen Rogers, was trying to explain this doctrine. And at the end of his most important paper on this subject, he says, look, here's what the one way to think about what the law of negotiability was really trying to do. It was essentially trying to mimic the system I've just described, which he said, imagine a chalkboard and everyone's name is on the chalkboard. And when you want to make a payment, some amount is subtracted from one person's balance and added to another person's balance. And he was explaining the doctrine of negotiability of physical instruments in terms of an effort to mimic a spreadsheet type system. In other words, I want to think of physical money, if we think about it at all, and I prefer not to today, as being sort of certificated ledger entries. That's essentially what James Stephen Rogers was getting at. We should think about physical money as certificated versions of the ledger entries, as opposed to thinking ledger entries as uncertificated versions of the real thing, which is the physical money, right? I'm trying to declutter the institutional environment just for conceptual purposes. Now, I recognize I've sort of started here midstream in the sense I haven't talked about who established this system, how it got established, who controls it. And we also haven't talked about operations, right? How these credits and balances come into existence, how they were issued and allocated to whom in exchange for what. And we're going to come to this momentarily. I just want to sort of establish the baseline system here. So now let's complicate it a little bit. I want to add a couple of assumptions. First, I want to just assume it's an organ of government, a government that's running this spreadsheet system. It doesn't necessarily have to be the case. I think historically, in principle, you can imagine this happening independent of any sort of collective governmental action. And we can bracket cryptocurrencies for the moment, but in actual practice, it's tended to be states establishing monetary systems. And so I want to think of this as public infrastructure, at least for now. We can question that assumption later. And now I want to introduce a second complication or assumption, perhaps, which is this question of operations, right? How did these balances come to where our balances just sort of allocated willy-nilly to people and institutions, right? To agents in the economy, or how are they issued? And here, I want to suggest that there are good reasons to issue these balances in exchange for financial assets, as opposed to other types of assets, right? It's of course feasible and might be a good idea for the government, since it's running the spreadsheet, to simply spend the money into circulation, right? It buys a battleship, and instead of debiting its own account and crediting the battleship maker, the government just credits the account of the battleship maker without debiting its own account, and more money is in circulation. And you can imagine all money coming into circulation that way, by expenditure by the government in exchange for real goods and services. But I want to suggest that there are good reasons to lend the money supply into circulation rather than spending it into circulation. And first of all, there may be no necessary connection between the optimal amount of government finance in any given period, of government expenditure in any given period, and the optimal supply of money outstanding. There's no reason why those should match up perfectly. It's also nice to be able, in case you wanted to engage in monetary contraction, it's nice to have things that you can then turn around and sell. And financial assets have this quality also. So, I want to suggest there are reasonable grounds for doing things this way. And I want to point out, at least in the system as I've described it here, we're going to complicate it a little more. It's going to start to look more like a real banking system momentarily. That in this case, the government itself is earning all of the returns from this pool of financial assets, right? The government is issuing new money in exchange for financial assets, and it owns this pool of financial assets. So any returns generated from this pool of assets go to the government, right? And we can think of that as seigniorage, right? Fiscal revenue from money creation. And the government's just doing it all in this case. Now, this may raise some concerns, the system we've described here. First of all, would the government be good at allocating capital in this way? We might have concerns that it just doesn't have the expertise for this. We might also have concerns about corruption, right? Perhaps these concerns are a little more salient today than they might have been 5, 10, 15 years ago, or especially salient today. But whoever's in charge of the government might have reason to allocate capital to favored persons, favored institutions in ways that will be contrary to the public interest. So there are reasons why we might want to think about our institutional design in ways that would both create good incentives for not investing poorly, and also to limit the ability of whoever controls the government to control this pool of financial assets. And so this is a reason for potentially outsourcing. And I want to get to outsourcing now, and we're creeping toward something that looks more like a banking system. But we still have the spreadsheets that's still run by some organ of government. And now the government's saying, look, we want to lend this into circulation. We want to invest the money supply into circulation, but for various reasons, we want to outsource this particular function, right? You could think of these investment managers as being like any portfolio endowment manager that's outsourcing their portfolio endowment allocation to different fund managers, for instance. And so here we're separating at least some and maybe all of the portfolio allocation to these investment managers. Maybe we think they will be motivated in part by the profit motive to do a decent job and earn good returns. And also this limits to at least to some degree the ability of the government to influence the particularized allocation of capital of the monetary portfolio. And so we're building in some separation between the government and the asset allocation function that comes into play with the construction of a monetary framework. And so note, however, that at least so far we haven't outsourced the actual ledger part of things, right? These are at least conceptually separable. The allocation of the portfolio on the one hand, and the ledger itself, which is the money, quote unquote, right? That's the monetary system component of this thing, which is the balances that individuals and institutions are able to hold. I want to note here that once you hire investment managers, that does not mean that the government is forfeiting the revenue from this. On the contrary, it should give the investment managers no more revenue themselves than is necessary to induce them to do a good job, right? This is still, the portfolio is still owned in a sense by the government. They're just helping to manage it on the government's behalf. So the government is still earning seigniorage from the system, even though it has outsourced the portfolio allocation function. The other thing I'd point out is delegating this task to investment managers does not imply completely giving up on any portfolio shaping rules, right? The government here is a franchisor of these franchisees, and it can impose whatever conditions it wants to. It can say it wants wide geographic allocation of credit. It can say certain activities are favored and certain are disfavored, right? Maybe we want to channel more investment into productive activity as opposed to backing assets, asset-based finance, and so on and so forth. Maybe we have a preference for funding small businesses, and so we offer them some preferential rates and essentially cross-subsidizing them in the system by large businesses. So you can imagine, any number of portfolio shaping rules that can be put into place, and outsourcing the investment management function here doesn't imply that the government gives up any ability to shape the portfolio. It just gives up the ability to make particularized investment decisions in this construct. Okay, so but we may have reasons to want to outsource the ledger aspect of this as well. And that's when things start to look more like a banking system, right? Where the monetary authority is sitting in the middle. Banks are franchisees of the system, and they're allocating the monetary portfolio on the behalf of the system. They're also maintaining the ledgers. Those ledgers obviously have to be stitched together in some way, right? We want this to operate as a unitary monetary system. So someone maintaining an account at one bank needs to be able to receive payments from and make payments to someone else whose account is maintained by another one of these banks. And that can all happen through the monetary authority itself. And of course, this is the sort of concept of clearing and settlement of payments within the monetary system. And this starts to look more like the system that we actually have. And in our system, the monetary authority does obviously maintain its own asset portfolio and its own ledger, which is the ledger of the bank's own balances that they hold with the monetary authority. But that isn't in principle necessary in the construct here that I'm laying out. One issue that I want to that the government, the state, is going to confront at this point, if not sooner, is the question of a problem that necessarily arises here, which is that once you have a circulating money in existence, it's possible, using the ordinary tools of contract and property and enterprise organization law and so forth, and the law of negotiability, which I already referred to construct enterprises completely independent of the monetary authority that are what we would call fractional reserve banks. I know that everyone in this room knows what that is, but an enterprise that doesn't have any particular authority to do so, but it's started by a private individual or individuals that is maintaining a small reserve of the established money with the bank or with the monetary authority, depending on who's maintaining the main ledger, and establishing its own ledger, right? Where it's issuing more money than it holds and is engaging in effect in money augmentation. And it's able to do this because it just says that the money that it issues is redeemable for the money that it holds, even though it holds it on a fractional reserve basis. But the law of large numbers means that it can often work out, unless there's a run, of course. And so the government has to decide what to do about this. Do you just allow that to happen? Or do you allow money augmentation to happen independently outside of the system the government, this infrastructure the government's constructed? And why or why not, right? Why is that okay or is it not? And I mean, there are multiple reasons to question whether it's okay. One is that the monetary authority, the government, cares how much money is outstanding. It's altering the quantity of money outstanding for purposes of macroeconomic management. And to have other enterprises out there that are doing it, but outside of the construct the monetary authority here has set up, changes the quantity of money outstanding, has macroeconomic consequences, has consequences on inflation, and also has consequences on the monetary portfolio itself, right? Because now these private actors are investing however they want to. And maybe engaging in asset-based finance, for instance, in pumping up asset prices as opposed to channeling the monetary portfolio into productive investment, which is what we want. And so there's this sort of threshold question about whether we need to restrict entry into this activity. And I call this in my book the first law of banking. Right, the first law of banking is this basic question: are we going to allow anyone to do this if they want to, or are we going to impose entry restriction? In other words, you need to have essentially what in public utility law is called a certificate of public convenience and necessity. Right? You need to have a license, a special charter, more accurately, to engage in this activity. And I'm going to suggest the answer is yes, both for the reasons I just described, as well as the instability problem, which we all understand very well, right? Fractional reserve banking does have this instability associated with it, unless it's backstopped by the monetary authority. And that instability has disastrous macroeconomic consequences. We have a deep, sharp macroeconomic disaster every time there's a widespread run on money or money substitutes. The banks that we have described here are essentially non-defaultable because they're maintaining ledger entries that are not themselves claims to the bank's asset portfolio, right? You could think of this as universal deposit insurance for the chartered banks if you'd like to. But we're envisioning that this money is not a defaultable, not insofar as their claims, they're not defaultable claims. And so entry restriction requires legally defining what constitutes a monetary instrument, and it has to be done in functional terms. And I think this is one of the biggest challenges of monetary system design, right? Is setting this perimeter. If we're going to have this public infrastructure, we need to specify what it is that the private sector is not allowed to do. What are you not allowed to do without a banking charter? A banking charter is itself a meaningless piece of paper unless it confers some kind of privilege. And traditionally, the privilege that we have thought of it as conveying is the ability to maintain deposit liabilities, right? You need a banking charter to do that. If you try to set up an ordinary corporation, a Delaware corporation, and have liabilities styled as deposits, you would be breaking federal law, not to mention state unauthorized banking laws. And so it is an aspect of banking law, but not one that we have thought about, in my view, quite carefully enough. And we need to consider what those functional terms are, right? How do we define what this privilege is that banks receive by virtue of having a banking charter? There are lots of money substitutes that we're all quite familiar with that seem to come quite close to serving a monetary function. Repo, Eurodollars, money fund shares, and of course today stablecoins. And these are issued by in some cases banks, in some cases security broker dealers, in some cases investment funds that have no special franchise from the monetary authority to do so. And I think there is a basic sort of foundational question about whether this is something we wish to allow. The system that we have today, and I'll come back to this momentarily, is one in which we have relatively free entry into this activity of issuing money substitutes, but the monetary authority, the central bank, backstops it all. They backstop it ex post. They argue that they pretend like they're not going to backstop it, but when the rubber meets the road, they do. And I think there are some pretty disastrous side effects that come from this institutional design that we should be questioning. Okay. So I mentioned this a moment ago, but entry restriction means defining in some kind of functional terms what is the privilege a banking charter conveys. Here is the provision as it exists today in federal law. This is 12 U.S.C. section 378(2) in the U.S. Code. It shall be unlawful for any person, firm, ... to exchange to any extent whatever, ... in the business of receiving deposits, ... unless ... you have a banking charter. That's essentially what it says. You're not allowed to receive deposits, quote unquote. I don't like that terminology. I prefer to think of deposits as being issued rather than received. But nonetheless, you get the idea, right? We do have a law that says to be in the deposit business, you need to have a banking charter. That's essentially what it says. And so this does raise the question, why isn't that enough? Why doesn't this definition actually work? And the problem for a banking lawyer is that we then look at the definition of a bank, and a bank is an institution that receives deposits. And so in federal law, the definitions are circular, right? We define a bank as that which maintains deposit liabilities, and we define a deposit liability as a liability of a bank. And so you're in a perfect legal circle. And we haven't had any effort to define in functional terms what constitutes a monetary instrument. And to me, that's one of the original sins of modern banking law. Okay, so let me say something about this New Deal system of banking law that I was referring to, that I propose we in part return to, but really, as I put it earlier, I'd like to follow through on the system. So it had roots in the Lincoln administration with the Banking Act of 1864, followed by the Federal Reserve Act of 1913, and followed finally by the New Deal laws themselves in 1933 and 35. And under this system, banks were governed in many ways as public utilities, right? As of sort of the 1933 system. So we had restrictive chartering, which I just referred to. Banks had the exclusive privilege of augmenting the money supply. We didn't have money substitutes like we think of them today. In the 30s through the, call it the 70s. I mean, yes, the Eurodollar markets were starting to emerge as early as the 60s, and the repo market was emerging as early as the 50s, but they're really quite small, frankly, until the 1980s. Even the money funds, which took off in the 1970s, didn't really get big until sort of the late 1980s. And so the money supply was dominated by insured deposits during much of this period. And so banks really did have something close to an exclusive privilege of augmenting the money supply. They were separated off from commerce. We had constraints on their activities, constraints on conglomeration. We had geographic constraints as part of an effort to maintain banking services in a geographically distributed way and access to credit in a geographically distributed way. Bank money was essentially a government product in the sense that it was mostly insured deposits. And the government was regulating the quantity of and interest paid on bank money. So reserve requirements, as we all understand from sort of Econ 101, function as what Jeremy Stein at Harvard, former colleague of mine at Treasury, referred to as a sort of a cap and trade system for the issuance of the money supply. And that's one way of thinking about what reserve requirements are, right? Reserves under a scarce reserves framework are a permit to issue a certain amount of money, and those permits are tradable. This system worked reasonably well. I don't want to overstate its virtues, but it worked reasonably well. But rather than fix its defects, we have allowed it to collapse. So liberalization has taken a number of forms over the past 40 to 50 years. Bank activities have been liberalized. Saleo Morova has a great paper on allowing national banks to get into derivatives dealing activities, and they now dominate that market. We almost completely discarded geographic constraints on banking. We discarded our rules on conglomeration, right? As we know, Glass-Steagall was eviscerated in 1999. Banks were desupervised, so we changed the nature of supervision during this period also. And entry restriction also collapsed, such that by the eve of the global financial crisis of 2007 to 2009, non-bank deposit alternatives exceeded insured deposits outstanding, et cetera, right? We had sort of every aspect of the New Deal system was either eviscerated or substantially carved back during the period I'm speaking about. And this was all combined with an open-ended backstop by the central bank here. And this is also, by the way, these trends are true to greater and lesser extents around the world, but I'm speaking from a US-centric perspective, at least for the time being. But central banks issued open-ended backstops for non-bank money substitutes. In fact, the law was amended in the early 1990s. US federal law was amended to, under lobbying from Goldman Sachs and the securities industry, to ensure that securities firms and other non-bank institutions would have more or less open access to loans from the Fed. And that coincided with the massive growth in financialization of the U.S. economy. So I refer to this system as liberalize and backstop, right? We no longer confine this activity. We no longer impose the sort of social contract on banks that we used to, but we nonetheless more or less backstop it all. The backstop is largely implicit, but sort of everyone knows it's there, and we see it re-arise seemingly every few years since 2008. And what are the consequences? Recurring financial panics. Obviously, 2008 is an example of this, but we had financial panics reemerge in COVID, for example. We have ever-expanding too big to fail institutions, a monetary financial complex with the Fed at its center, a loss of monetary control, rent extraction and upward redistribution, asset price inflation, which is really baked into the system we have, right? Our system is designed to push up asset prices as a key, if not the key mechanism of monetary policy implementation, financialization of the economy, and democratic erosion alongside. So I want to come back as I wind down my talk here to conclude to viewing banking law as a system, and hopefully my talk has helped to clarify that there are certain questions that banking law has to answer. Our system of money and banking has to embody answers to these questions. What are the legal institutional features of money, right? What counts as money and what doesn't? What entities may legally issue it? Are we going to impose entry restriction? How do we choose and create them, right? If we're going to have a system of chartered banks, we need to have some system for allocation of banking charters. This is a major problem, and ensuring that this is done in a fair and open way. It's a standard problem from public utility law also, where we give exclusive franchises to firms, and we need to do that in a sort of open procurement process of some sort. Under what terms and conditions must banks operate? What is their relation to the state? One particular question, just to come back to this for a moment, is remember when I said when the public's outsourcing the allocation of the monetary portfolio, it shouldn't imply that the public is giving up all the seniors revenue that comes from money creation, right? It should only give up enough revenue needed to ensure that its franchisees are doing a good job, right? McDonald's does earn franchise fees from all of its franchisees. Obviously, that's how franchising works, and I think that analogy works perfectly well when it comes to the banking system. And just as an aside, this is the way things used to work. So under the original National Bank Act signed by President Lincoln, all national banks had to pay an annual franchise fee to the federal government in return for having a charter. And in fact, even before that, if you go back and read Andrew Jackson's veto message for the Second Bank of the United States, his real complaint in that was that the Second Bank was required to make what were called bonus payments to the federal government, the franchise fees. The Second Bank had to pay franchise fees. He thought they were too low and that the charter should be auctioned off so that the government could recoup its investment, right? The money should come to the public, in other words, and not go to enrich the shareholders and management of the Second Bank. And the national banking system was originally built on that principle, and we've lost sight of it, right? This comes from thinking, I think, excessively of banks as being private institutions as opposed to seeing them as franchisees of the state. If we do take the franchising perspective, then it raises the question about the revenue split as between the banks themselves and the public sector. By the way, the franchising vocabulary is, I owe at least to Saleh and Bob. In the money problem, I referred to this as a public-private partnership. I was writing that book at the same time they were writing their finance franchise work. And I wish I had thought about this more carefully because franchising, public-private partnership implies a sort of horizontal relation of equality, whereas franchising is a hierarchical or vertical relation. And I think that's the more appropriate framework. And I think they got this more right than I did in terms of the vocabulary they're using to describe it. So I've since adopted their terminology. How is aggregate monetary control exercised? Do we want the monetary authority to have some measure of control over the quantity of money outstanding, or not? Do we not think that's important in managing the macroeconomy? And not on this list, but also related, is the question of whether interest is paid on money as in the conduct of monetary policy, and if so, who's deciding how much interest is paid on balances, and whose balances is it paid on? In other words, is the monetary authority simply administering the rate on its own liabilities, or is it administering the rate on the liabilities of the banking system as a whole? And that's a topic we can turn back to in Q&A if folks want to talk about it. And finally, the mechanics of money transfer. I mean, there's basic questions about clearing and settlement and the payment system, which I'm not going to get into, but again, we could come back to in Q&A. So this is my last substantive slide, which is just to provide a snapshot of the system that Lebman and I in our most recent paper, which was the Rebuilding Banking Law paper. This is the components of the system that we outline. I'm not going to go through this in detail. Most of these topics I've covered in some form or fashion, but the paper is the part of the paper that deals with the design questions is organized in this fashion. What are member banks? What is bank money? How the interest-restriction system works, the governmental guarantee of bank deposits. Then we get into the governance, economic governance, then ownership and control, and duties to the public, which gets to universal service, which Patrick alluded to at the beginning of the talk. And again, I can come back and speak more to in Q&A if people wish. So let me conclude here. Monetary liberalization, which has been pursued in the past half century or so, has actually been a really radical experiment. In some ways, we're doing free banking again, right? Free entry into the issuance of money and money substitutes. But now we're backstopping it. The public sector is backstopping it. And this is part and parcel of a broader liberalization agenda and infrastructure industries. I think this was implicit in my original slides, my initial slides, rather. Stephen held up my networks, platforms, and utilities book. From a sort of conceptualization standpoint, I think it's useful to think of banking law and the monetary framework more broadly as being akin to other public infrastructure, and the governance aspects of it in many ways raises similar problems to other aspects of public infrastructure, and that's a useful, I think, productive lens through which to see monetary system design. And I'll just conclude by saying, again, repeating that I think there's much to be said for restoring and then following through on the design of the New Deal system we had around mid-century. John Maynard Keynes famously referred to the general theory as being moderately conservative in its implications, which always gets a good chuckle. But I sort of know what he means, right? When I speak about banking, there's something moderately conservative in what I'm proposing, in the sense that I do like the idea of back to the future in some sense. Let's take the stuff that we had and try to perfect it. The radical experiment is what's been going on in the past half century, which is really unprecedented and has landed us in a real quandary. So with that, I'll stop and happy to entertain any questions.
So, Professor Ricks, that's really, really, really helpful. My role is to get the questioning started. I'm going to make one observation at the beginning to kind of queue up 3 questions, and then I'm going to turn it over to Stephen to ask questions from the chat and from the audience. I have to say, just for the audience, in preparing for this, I listened to you speak to Ezra Klein about the money problem, which is something you wrote to deal with your proposal to backstop what you called the shadow banking market. So I'm going to go towards that issue. And then and in that interview, you describe the panic of 2008, other panics, and you say that most banking failures and most panics that affected the whole financial system were the result of the seizing up of short-term liability markets, short-term funding markets. And so you go into your book, The Money Problem, in quite a bit of detail about that. I learned a lot from you. And I learned a lot from your discussion on YouTube. Speaking of YouTube, you spoke to the young scholars and you had some interesting conversations about what is the shadow banking market? How large is it? What is commercial paper with these asset-backed lending and what are the repo agreements? It was very interesting to me because the size of these markets, according to at least some analysis, seemed to be dwarfing even the size of the banking sector, or at least rivaling it. So that, and I stumbled then onto a wonderful discussion of many scholars critiquing the money problem that you responded to each one in the Geider volume, and I landed on Margaret Blair's question. You answered each one, I thought, really thoughtfully. So that's what I wanted to queue up for you. And my three questions are pretty focused. Two observations first, though. Margaret Blair quotes William Dudley speaking to the New York Bankers Association in 2013, and he's asking this large question: are collateralized money markets destabilizing the banking system? And of course, he's looking back to the 2007 to 2009 period and trying to deal with that. And he just says there's two choices. You can either reduce the shadow banking sector and its importance and regulate it legislatively and regulatorily, so that you take away the risk of the collapse of asset prices and the seizing up of those markets and you substantially shrink it, or you can provide a central bank backstop. Now, obviously, you could probably do both, and you're going to probably tell me you have to do both, but he was making it a stark choice. So I just want to probe that a little bit. And then my only other observation is, before I ask my three questions, is I was preparing for tomorrow's talk with Mirza Baradin and reading her book, The Quiet Coup, and she talks about private utilities, and she starts out her book with Pacific Gas and Electric and the Paradise Fire and the fact that they wouldn't fix their towers, their 72-year-old towers, and they ended up causing fires that destroyed a huge number of communities, massive amount of infrastructure, killed people. So the question is, how did this entity get created? And the answer is it was more like a Morgan Ricks model. It was privatizing a company, sticking it under public utility regulation, assuming the regulators are going to do their job. And she critiques the idea that regulators are going to do their job. What they ended up doing is taking the company to court, giving it a negligence conviction for killing people and taking away all this value. They gave it a $3.5 million fine, which was a slap on the wrist against $200 billion in revenue. And then the company, because it was privatized, got to go through not one, but two bankruptcies, one on the lead up to this crisis in 2001 and one after. And then they got to play the regulators and buy them off and do rolling brownouts and shift the costs of their non-fix onto households with lost electricity. I'm only mentioning that because all over the country, we've seen the failure of regulation. And here in Michigan with Consumer Power, we're going to do a statewide ballot initiative, try to keep them from buying off legislators and regulators, trying to limit their campaign finance and their lobbying abilities. And we have the highest rate of brownouts, the highest rate of grid failures, the highest rate of non-fulfilled asset requirements to rebuild the network. So we're paying some of the highest prices for some of the worst service. I'm just presenting that because that fits on top of your idea that a regulated utility of these private corporations can work, and I'm putting in the problems. And I think that's what Margaret Blair did. So now to my three questions. She asked to answer William Dudley's challenge about reducing the shadow banking sector by regulating it or banning parts of it or providing the backstop. She says, isn't insuring short-term securities without regulating the issuers of those securities a recipe for massive moral hazard among shadow bankers? And looking back, she discussed mortgage-backed securities and the collateral debt obligations and even the credit default swap insurance instruments that made it possible to move those instruments. But then she goes into, and I've just found this so helpful, she says, given all the other causes of the global financial crisis, and this is just directly to your book, Money Problem, why is financial stability the key problem that must be addressed to avert the next collapse? And she says, as I read my library shelf book of scholars in the field, they point to other culprits. And so she points to, Simon Johnson and Kwok. They say the problem is banks are too big to fail. So we should be reducing their size. And I'm assuming you would favor that, some of that, although you're critical of Dodd-Frank. Second, she says federal bank regulations that were supposed to increase mortgage lending activity in the high-risk populations, where the regulators were actually causing the problem. So here, regulators cause the problem: reckless lending by the mortgage brokers, excessive borrowing by homeowners, promiscuous financing by Fannie Mae and Freddie Mac. And Gretchen Morgenson wrote a whole book on that. The rating agencies being corrupted and giving assessments of debt quality that were basically wrong. Complexity of derivatives constructed to allow financial institutions to do repackaging in portfolios that really should be banned, not regulated. And then use of excessive leverage by banks. Finally, poor corporate governance, and even one culprit is low interest policies by central banks. So I'm only asking that because I'm wondering if backstopping central bank lending, backstopping through the central bank, shadow bank lending, this very large market, which some suggest, and you suggested, I think in one of your talks, that it was 28 trillion in the United States. Adair Turner for the Financial Service Board in 2014 suggested it's $100 trillion market worldwide. And that compares to, 4.5 million state and local government bonds, municipal bond market in the United States, $15 trillion corporate bond market. It's a really large market. Isn't backstopping that, without the ability to rely on regulators to really regulate it, like throwing gas on a fire?
Oh, thank you. So just to clarify, so I'm against backstopping. What I want to do is have only chartered banks be able to issue money and money substitutes, and that would be backstopped for those entities only. But they will live in a very special institutional environment that is as described, right? Something resembling the New Deal system of money and banking. But when it comes to, say, take a Goldman Sachs. So in my world, Goldman Sachs would, first of all, be required to divest its depository institution. It does own one. That's not a big part of its business. It's mostly a broker-dealer firm, institutional broker-dealer and wealth management organization, but largely an institutional broker-dealer and investment bank. So it would divest its bank as under a Glass-Steagall style requirement. And then a broker-dealer investment bank such as Goldman would not be entitled to rely on overnight repo funding, which is a money substitute. So they would have to term out their borrowings. They'd have to finance themselves in the long-term capital markets as opposed to the short-term money markets. And they would not be eligible for a backstop in my world. I think once you're funded in that way, you're relatively safe for bankruptcy, certainly compared to institutions that fund themselves on an overnight basis. And so I just want to clarify that I'm not advocating for extending a federal safety net to the shadow banking system. I want to shut down the issuance of, when I say shadow banking, what I mean is a financial institution that doesn't have a banking charter that is funding itself like a bank in the sense that it has overnight or very short-term liabilities on a large scale. And my answer to that is to disallow that funding model by anyone who does not have a banking charter. Now, there might be some de minimis exceptions, et cetera, which we could talk about. I go into some detail about that in the book, but I just want to make sure I'm not misunderstood. But to the larger question, which I think is a completely fair one, on the financial stability side, which was my big focus for a number of years and something I still focus on, but was sort of my really primary scholarly focus for between 2010 and 2016. Like many people, I was focused on this problem of instability, having come out of the financial crisis. I mean, I was pretty bought into the system we had and had a pretty conventional views about it until the financial crisis. That's what really overturned my worldview. So in many ways, I'm a latecomer to some of the issues you all have, some of you at least, have been thinking about for a much longer period of time. But I think there is a fair question about whether monetary reform of the type I'm describing, in other words, not having private money anymore, what are currently shadow banks that have to term out their funding, and chartered banks would have sovereign liabilities in the sense that they're not runnable because they're fully backed. You can think of that as full deposit insurance for chartered banks only. So you'd have a fully sovereign money supply that wouldn't really be runnable. Does that really solve, to what extent does that solve our financial stability problems? And I think to a significant extent, it does. This chapter 4 of my book is titled "Panics in the Macroeconomy," and it's sort of tracing this link between financial panics, which I specifically mean runs on money-like instruments. That's what I'm defining panics in that way, sort of following Gary Gorton and some other economists. As you look over financial history, almost every deep, acute macroeconomic disaster, certainly in US history, but I think it's also true more broadly, has been accompanied, insofar as it arises not from a war or a natural disaster, but arises from within the financial system, has been accompanied by and coincided with a run on short-term monies. And in US history, you can go back. I mean, you can go back starting in 1837 if you want to. And we could up through 1907, up through obviously 1933, up through obviously 2008, right? We could sort of go one by one. But pretty much every deep recession we've ever had in this country was coincided with, I'm talking about acute, sharp macroeconomic contractions, has coincided with a financial panic. I also think we should interpret globally other important episodes with this phenomenon, and I have a fairly lengthy examination of the Japan experience in the 1990s in my book, as well as East Asia in the late 1990s, and the Scandinavian countries in the early 1990s, sort of an epidemic of international runs on money substitutes in that period. And I do think there's a pretty strong case to be made that this is a phenomenon we really just want to avoid. We want to avoid runs. That doesn't mean that you can't have macroeconomic damage coming from other sources of within the financial sector, but this one seems to be particularly damaging. I think there's a pretty strong case that there's pretty strong support for that proposition. And again, that's chapter 4 of the money problem. So that's where I sort of part ways with Margaret. And it isn't a question of causation, right? Everything has multiple causes that happens in our financial system, right? You have a bunch of contributing causes that lead to some kind of conflagration. But here's one. I do think that short-term, large-scale, uninsured short-term funding within the financial system is sort of like this sword of Damocles dangling over the head of the economy. And there's all sorts of things that can cause that sword, the thread that's holding that sword, to become detached. And we could talk about, too big to fail. And I do think my proposals would go a long way toward countering too big to fail. We could talk about Fannie and Freddie. We could talk about bad consumer protections. We could talk about the credit rating agencies and so forth. But without that thread coming loose, I think you're unlikely to have the sort of macroeconomic damage that we experience. And that's what we really care about, right? We care about events within the financial sector that are going to cause a sharp, acute macroeconomic disaster. And my view is that without the panic, the macroeconomic damage from those sources would be much less severe. So I hope that wasn't too.
No, that's good. I'm gonna group my two questions. They're short.
Wait, Patrick, we're already over an hour, and I just want to.
We gave 75 minutes, I think. Yeah, we have 75 minutes.
Sorry.
Yeah, no, we're fine. I'm going to make my two questions short, and more. Professor Rick's already alluded to answering the other one, and
I'll give short answers to let others chime in.
Well, it's the part of your money as infrastructure I like the most. It had to do with why you want to solve the problem of the unbanked with universal service, and you even to the extent of requiring a cross subsidy, and you say all kinds of reasons why this will help the economy, the people, it'll help everyone. And so I guess my question to you is why has the problem of the unbanked persisted for so long? And would your solution be like a Treasury Direct or central bank digital accounts or postal banking? And then just to make sure I give you my second question, I'm sure you can answer them both. What about re-regulating credit cards, changing the Marquette Bank thing that said states can't put limits on usury? Why not take on usury? Why are we charging 28 to 34% for this vast swath of people whose debts are making it impossible for them to live viable economic lives? And would you re-regulate credit card industry, payday lending directly? That's the two questions are really linked.
Yeah, I'm just going to briefly address both of those. I'll do the second one first. I mean, I think we've done an abysmal job of consumer financial protection in this country, and that's not just about monetary system design or banks. That's about the financial system writ large, and that isn't even just about credit. It's also about asset management and other aspects and credit reporting agencies, bureaus, and so forth. And so I'm a firm believer in. I think the best thing to come out, one of the very best things to come out of Dodd-Frank, and I'm a big critic of Dodd-Frank, despite the fact that I participated in helping to design it, was the creation of the Consumer Financial Protection Bureau. Unfortunately, it's been largely neutered, but I do think it was an important advance. Universal service, right? This goes back to the public utility concept, and I understand that the public utility is not a perfect, as far from a perfect creation. I think there are reasons to be concerned about direct governmental control over the system of money and banking for reasons in part that we're seeing right now about when it comes to governmental control over media companies. And we should be concerned about separation of powers issues. And I think there are advantages to not having enterprises necessarily under direct governmental control, but I don't want to sugarcoat or minimize the pathologies and problems that are well documented associated with public utility governance. I just think it's sort of like what it was that Churchill said about democracy. It's the worst of all systems. It's the worst system except for the rest of them. I'm getting it wrong. And so I think there are virtues to these systems. When we talk about universal service, right, this goes back to the creation of the postal system. And this is George Washington in 1792. A year after he signed the law that created the first bank, at Alexander Hamilton's urging, he signed the Post Office Act, which was designed to create a system of cross subsidies to make sure the whole nation was covered by this basic communications infrastructure, really the only communications infrastructure we had in those days. And it relied on a system of cross subsidies and to make sure that we had universal access even out on the frontier. And that principle is embodied in public utility regulation, where if at least traditionally, if you live within the franchise area of the public utility, you pay a uniform price. And that has meant that more densely settled areas, more densely populated areas are essentially cross-subsidizing more remote areas. And cross-subsidization can work in different ways, right? The old Bell system, I have a soft spot for the old Bell system. I recognize there were some problems with it, but it had a lot of virtues, and among them was cross-subsidization, both to rural areas and to residential customers coming from more populated, denser urban areas and from business users. And I think there are a lot of virtues to those kinds of systems, as opposed to using traditional tax and transfer systems for achieving universal service. And I think that banking law in the old days was designed more that way, right? We became a more unbanked country when we liberalized our system of money and banking and moved away from the New Deal public utility model and toward a more privatized model. Lastly on that is, I have a paper also with Lebanon and John Crawford on Fed accounts, which is in spirit quite similar to some of the work that Bob Hockett has done and talked about, which is asking the question, why don't we just let everyone have a bank account at the central bank if they want one, right? Not mandatory, but why is this an exclusive privilege of the banks? We have this public institution. Why shouldn't it serve the public more directly? And I think there's some merit to that. I think we're a long way from making that a reality. But as much as anything, that paper is a thought experiment. So with that, I'd love to hear from others.
We are so grateful to have you here. Stephen's taken over and going to ask the next questions, and he'll take and end the show.
Thank you. And I have a note of a AMI Educators Appreciation at the end. But first, we're going to go to Nelson, who's been patiently waiting.
Morgan, can you hear me? Yes?
Yes.
Okay, great. What is your view of stablecoin, being that it's not that anybody can open it as a bank? And my second question is, does it really make sense to have a public bank specifically at the local level having to have FDIC insurance since it only has one depositor, a city or a county? What is your view? Thank you.
Yeah, so The second one's a little more difficult to answer. Let me start with the first one, which is stablecoin is an instance of the same shadow banking phenomenon we've seen in so many other areas, right? From the growth of the euro-dollar market, which is dollar-denominated short-term liabilities by institutions that do not have federal bank charters. It's similar to a money market mutual fund in the same respect. It's similar to an asset-backed commercial paper conduit, which we saw grow in the early 2000s, sometimes called structured investment vehicles. That's a version of them. And on and on and on, right? And all of these are ways of satisfying money demand by issuing money substitutes without a banking charter. And we've seen problems with these institutions. Every one of these institutions, types of institutions, every one of these categories has had an unraveling, at least one unraveling, in many cases more of them, that has required public sector intervention and backstopping. And stablecoins, I predict, will be the same, right? If they grow to be larger scale than they are right now, they're already getting pretty large, and there are predictions that they are going to grow much, much larger. We're going to have an episode of runs. And the central bank is going to have to make a decision about what to do. And my prediction is that they will not let it proceed due to the risk of a deep, sharp macroeconomic contraction that's associated with panics and runs on these entities. And so, in my view, you just shouldn't be allowed to have that funding model unless you have a banking charter. And that's just sort of the start, what I call the first law of banking. I mean, that's the starting point for a rational system of money and banking. Otherwise, you really do have free entry. And the central bank then ends up having to backstop ex post. And that results in lower funding costs ex ante and tends to ratchet up asset prices and so on and so forth. So that's my basic view on stablecoins. On your first question, I haven't ever thought about that. I mean, a bank with one, I guess there's a question of like a bank with one depositor. It's making and receiving payments presumably from that account, but it's not, no one else is maintaining an account there. So there's no sort of law of large numbers at work. I suppose I'd have to think a little bit about FDIC insurance. I mean, I can recognize there may be room for exceptions in certain cases.
Thank you, Morgan.
Thank you, Nelson. Sam, and then Mike and John, if we have time. If you're okay, Rick, Professor Ricks, with another 2 questions or so, maybe 3.
Sure.
Okay.
Great. Thank you, Professor.
And then we'll follow directly with Bruce and his talk. But go ahead, Sam. Thank you.
Yeah, thank you so much for the talk. I learn so much every time I listen to you or read your work. So thank you for that. I have a question kind of about nomenclature and what's advisable in advocacy, in conversation, in law, with regards to the term fractional reserve banking or fractional reserve. In my experience, it generates an awful lot of confusion. In the textbooks and in political discourse, you frequently hear the idea that banks are taking in, $100, setting aside 90, or set aside 10, lend out the other 90. And as you know, that's not the way that it works in credit creation. But what I think I just heard you say is that in shadow banking, that is the way it works. So it might be accurate to call shadow banking fractional reserve banking, but maybe we shouldn't call credit creation by licensed banks fractional reserve banking, or at least if we want to disabuse our political leaders, our educators, and so on, that what they're calling fractional reserve is not what the shadow banking version of banking is. Have you run into that problem, and how have you decided to handle it?
Yeah, it's a great question. And it's a question about, there's a lot of terminology there's a lot of baggage that comes with our terminology. I did use the word fractional reserve earlier. I mean, I meant that in a sort of literal sense, in that, it's obviously true that loans create deposits. And I think that's something a lot of people have difficulty understanding. But banks in the first instance, when they make loans, are not lending out some pre-existing money they received. They're crediting a deposit account in exchange for a new asset, which from their standpoint is an IOU from the borrower. And so we all know that's sort of mechanically how it works. It is still true that even a chartered depository bank has a reserve, a base money, that is equal to a fraction of its deposit liabilities. And in that sort of descriptive or maybe overly literal sense, we can refer to them as fractional reserve. The problem is that when we use that terminology, sometimes that brings along with it this Econ 101 story about deposits coming in and then going out, and it makes it sound as though it seems to imply that one is accepting the story that banks are sort of merely intermediaries as opposed to engines of money issuances, which is how I think about them. And so there is a tension there. I do think, just in a literal sense, I find it fine to use the term fractional reserve banking. What the problem is, the baggage that comes along with it. And I'm not sure how to solve that problem. I think I think the problem has to be solved by the kind of work that AMI is doing here, and through education, and maybe ultimately rewriting of textbooks. I mean, I obviously teach banking law, and believe me, I disabuse my students of the sort of intermediation paradigm that dominates the field. But I'm not afraid to use the term fractional reserve banking once we have sort of established that reality. And so I don't know if that's a satisfactory answer to you, Sam, but it's a problem that's broader than just, I mean, the term bank, the term shadow bank, right? The term shadow bank, I mean, this is, you sort of have to define your terms every time you speak about money and banking, because everyone comes to each of these terms with sort of different understanding. I mean, originally, the term shadow banking really meant, I mean, it was used by a PIMCO economist and later by Gary Gorton and others in the economic establishment, really to refer to a very specific phenomenon of using a large quantity of short-term debt, short-term or demandable debt, to finance a portfolio of capital market assets, longer-term financial assets. And originally, it was about the asset-backed commercial paper conduits, or SIVs, created by Citigroup and others. And that's what was being referenced, right? It was really in reference to a funding model, right? But if you ask the Financial Stability Board or the BIS or the Treasury Department or sometimes the Fed, if you ask officials or economists at this institution, what is shadow banking? The Financial Stability Board says shadow banking is extending credit without a bank charter. That's not what it originally meant, right? It wasn't any old finance company wasn't necessarily part of the shadow banking system. The derivatives markets weren't where people had in mind originally with shadow banking system. It was very much about the money market, right? Overnight debt was what we meant. Now that term has taken on proportions that when you use the term shadow banking, you have to be very specific if you want to limit it to the original meaning, and it has lost that meaning, and I almost think we need another term. We may need to invent another term to describe what I mean by shadow banking, which is sort of the original incarnation. So that's all by way of saying that terminology does get in the way sometimes of understanding here. So I appreciate the question.
Thanks, Sam. Mike, do you or a question from the chat?
No, I'm not on chat duty for this.
Okay.
I do have my own questions here. So first, I'd like to.
Good.
Professor Ricks, thank you so much for your excellent presentation. It really helped me to understand your framework. Admittedly, I'm not familiar with your work, so I'm a bit of a newbie here, so I have to excuse the rudimentary nature of my questions. So I have two questions. My first question is, and maybe you went through this and maybe I missed it, or you've dealt with this in other places, but what was your definition of money? And then what is your opinion of the Legal Tender Act of 1862, which enabled the greenback?
Those are really good questions. I mean, I don't define money, and I've been writing about money for, how many years now? I don't know, 13 years or so. I don't know, 15 years rather. And I've never seen a need to define it. I know that seems backwards in some sense. And I mean, I'm sort of fine with the traditional economic description of money as being a medium of exchange and a store of value. And what's the third characteristic? Someone could tell. Oh, unit of account, right? So, some concern. I mean, in many ways, that might even be the most important. I'm sort of okay with that, except that it doesn't capture the near monies that I think are very close to being cash equivalents, right? Like repo and Eurodollars to a certain extent, and money fund shares generally aren't a medium exchange. I mean, sometimes you could use that, you can write checks on them. The people don't do that often. But when you write a check on a money market mutual fund, it actually has a relationship with the bank, which is how it's hooking into the system of clearing and settlement. And I do think money fund shares are money. I think what I do say in my writings is that once you have an established medium of exchange, in this economy would be the dollar, then any financial client that has a very, very stable value in relation to the established medium of exchange will tend to take on monetary characteristics, and that ends up being short-term debt, because otherwise you have interest rate risk as well as credit risk. So very high quality short-term debt is instruments that don't really have much in the way of price risk, right? Even if interest rates go way up in the short term, because they're redeemable tomorrow, you're going to get your par value. So they don't have a risk of declining relative to the established medium of exchange. And one thing I say in chapter 1 of the money problem is that this is a really important feature. This feature of price protection, right? The protection against a fall in price of an instrument. And that's what makes it have a monetary characteristic, because you can plan, in a world in which prices are relatively sticky in the short run, there is built-in demand for financial assets that also don't change in price very much, right? Especially in a world in which contractual obligations tend to be specified in nominal terms. Now, that's not a definition; it's more descriptive. And I take some comfort. I started by talking about Richard Feynman. I'm gonna refer to another scientist I admire, at least on some days, which is Richard Dawkins. I only very recently read The Selfish Gene. It had been on my list for a long time, but I decided to read it. And one thing I found super interesting about it is that he ends up not even really defining what a gene is, and he's quite deliberate about that, and talks about how it's actually quite difficult. That his title is The Selfish Gene, but he doesn't really tell you exactly what he means by gene, right? It's not just a particular piece of chromosome, but it's hard to define it in other ways as well. And he ends up with what ends up being, he admits, a somewhat circular definition of what a gene is. But it did make me feel a little better, because I wrote a book with money in the title without defining money. But at least I have Richard Dawkins as a precedent in doing so.
You're muted, Mike.
And then the Greenback Legal Tender Act of 1860.
Oh yeah. So look, it was so the Greenbacks were a response to an exigent situation, as were the Continentals in certain respects, 70 years earlier or 80 years earlier. And look, I think direct issuance by Treasury does have risk. I mean, there's one sense in which I will sound a little bit traditionally economistic, is that I think there is an inflation bias on the part of the executive branch, is that inflation will show up later, but you want to goose the economy now. And that's sort of economist standard definition for or rationale for central bank independence. And I do think there is something to it. And so I do have some hesitancy to putting control over the money supply directly under the executive branch, both for that reason and for separation of powers reasons. It's a tremendous amount of power to put in the executive branch. And so for that reason, for those reasons, I do think that there is value to monetary authority independence. I just think that the legislature needs to define very clearly what it is that the monetary authority is doing. And I think the problem is, or one way of thinking about the problem is, our laws are not as well designed as they could be to create the kind of monetary system we want to have. But in my view, a sort of ideal monetary framework would embody a degree of independence for the monetary authority and not put it directly within the executive.
Thank you very much. And I'll just say that, of course, we're dedicated to establishing a greenback type system. And that's our main modus operandi. And we would define, based on Stephen Zarlenga's work in Law Science of Money, the definition of money being an abstract social power embodied in law with the three functions. So thanks again.
Thank you.
There's two more questioners, but I think we've gone long, and we should take a break and give you a break, Professor Ricks. But I want to leave you with a thought. Tomorrow, we're going to have Leah Downing, who the author. She's a young woman from North Carolina, now in Cambridge, working. and she comes at it from a political science, not a legal stand, even though a lot of political science people end up in laws, but our monetary policy as if democracy matters. And I want to set that up by saying Jacob Fining wrote the book, Moral Economies of Money. And he leaves off at FDR. I think after FDR, he gave up on moral economies of money. Just saying. I don't know. We could ask him. But Leah Downing is saying we can have a moral economy of money. She wants to bring it back. She wants to have citizens engage so they can engage their legislators. So somebody in the legislation understands money better than what we have right now going on. So in doing that, I wanted to say your presentation, first principles, the outlines you've made, when we think about how to build a consensus, you've helped give us a framework for our thinking, and we much appreciate that. And
well, I appreciate that. I do have Downey's book, and I'm going to try to make her talk tomorrow. I do have a family obligation, but this tremendous gathering and a really, really remarkable agenda that you were able to put together. So congratulations. It's a pleasure to be a part of it.
And I want to leave you with a last thought. I'm going to tell a story, a cultural anthropologist story, and I'm also do linguistics a bit. I'm going to say thank you in Siberian Yupik. It's Igumsi Kana Halik, meaning thank you very much for spending this time with us. And I only say that to you as an anthropologist. Every year I would define culture, the word and I'm a cultural anthropologist, right? Like you're a money person. Every year I define culture differently. So there you go. So, hey, and I loved Feynman and I loved your science authors too. So thank you very much for being with us and give your daughter that fantastic education and so she can be a Leah Downing or a great person, however she develops herself. So
we really appreciate it, Professor Ricks. And if you get a chance, I don't know if Nancy King is still your dean, but I spent 2 great years learning to be a lawyer at the Supreme Court of Michigan, and she is one of my heroes, so you can tell her that.
Well, you mentioned that in an email. She's retired, but she comes by every once in a while, so I'll mention that to her.
Her mom was a legend, by the way. I don't know if you know, she was a little infant, and her mom was getting Title IX through the courts, and she, I think, became her mother in some ways. So thank you.
Dr. Ricks, before you leave, please save the chat. There are some questions in it for you that you might find interesting.
Okay, thank you. I'll do that.
Okay.
Thanks, everyone.
Well, I'll say goodbye in Yupik to you. See you later. Okay.
Thank you.
Bye-bye.